Hello, and welcome back to the Borth podcast. Today, I have a guest of mine that we got connected down in Orlando, Florida. So just think about this. At the time of the recording, it's still January, but we happened to, I actually ran into a colleague of yours, and actually your uncle, if I remember this, right, Matthew?
Correct.
We had a chance to go to an industry meeting called Circle of Wealth. It's their software user platform. And anyhow, it was in Orlando, so I had a chance to leave Fargo. I mean, it was tough to do, tough to get a ticket to get out of here. And Matthew, you have gone to a lot of Circle of Wealth as well in the past, and we're going to talk about that a little bit. But again, I want to welcome you. You are in the real estate mortgage business.
Hmm.
Is there any other type of mortgage business? Maybe you can mortgage other things. I guess when I said it, it sounded kind of funny,
Yeah.
but so the purpose of the podcast today was just to give you a little bit of idea of what's going on in the industry. So I have some, I have some thoughts, and a lot of the people that listen to my podcast know what my thoughts are around mortgages and who should control your money. So I thought today would be a great opportunity to hear from somebody else that's in that industry. That is, what'd you say? You're Switzerland. You don't care one way or the other,
Yeah.
but his thoughts on, who we'll get into that. But
Hmm.
just the thoughts around mortgages, because it is a big topic of conversation right now. There's changes going on, interest rates, people, the housing market is still well underdeveloped. I mean, there's still a tremendous shortage of people in houses. I don't remember what the number is, but it was some incredible number I heard a while back. Um, how many houses do we actually need? Like an extra, 250,000 just to meet demand today. And again, you can check me on that. And I don't know if that number is correct, but it's just something crazy that we're short. So it's just a topic of conversation here. A lot of people talking about. So Matthew, is it Shanlian? I want to make sure I get
Yep.
your pronunciation right. Okay.
Shanlian. You know what? We're Armenian. I kind of grew up with people butchering it, so if you get close, we're pretty happy.
So it depends on where you're from. Now you're located in Ohio, so
Correct.
you're no stranger to the idea of wanting to get to Orlando in the
Yep.
first part of January. So welcome, Matthew. I appreciate you taking the time to get on the podcast with us. I'm looking forward to just the information that's going to flow back and forth and the
Yeah.
conversation we're going to have. Just because, again, sometimes people hear my voice, they hear me telling it. It's always good to hear your point of view when it comes to running the mortgages. So welcome, Matthew. Appreciate you taking the time.
Yeah. Thanks for having me. I really appreciate you having me on.
So tell me, your company name, maybe just get a little background, where you guys work out of. My clients are obviously across the United States. So maybe just give me a little background on your company, what you
Yeah.
do, how long you've been doing this, why it's a passion of yours, and maybe just give a little background to that.
Yeah. I always start this part of the conversation with new friends is, my father started our company in 1999. He's still actually part of our company. He's enjoying a little bit of semi-retirement as he's earned it. But before we even started really a family mortgage company, my father was in financial services. Started in the 1980s with Prudential, and for many years worked in the financial services industry. And about the mid 90s, he kind of saw a need because there was a disconnect between people in lending and also people in financial services. Not that they were adversarial, they just didn't talk. And so what that lended to a lot of times was people getting a mortgage that the financial advisor didn't know anything about, and vice versa. So set out to start a mortgage company and really service specifically the financial services industry. And we started kind of in the Midwest. We're in Ohio. We had about 5 states that we lended in, excuse me. And then over the years, and I graduated college in the early 2000s and have worked here ever since. So I've been in the mortgage industry almost 20 years myself. Ultimately, we stretch over all 50 states, so we're licensed in all 50 states. Our company is Cross Country Mortgage, and what we decided to do about 8 years ago was similar to what people in the financial services industry. We wanted to tie into a larger entity that would be able to support our growing needs for licensure and products instead of kind of going it alone. So my role as the vice president of lending with Cross Country Mortgage, and our group is that specifically focuses on working with financial services advisors and their clients to make sure we are fixing their needs in the mortgage industry as far as home buying, refinancing, debt consolidation, but making sure that that is a communal conversation between all parties and not just the client coming to us as a third party and saying, "Hey, I think I want to do this," and not knowing that maybe that's a poor idea for the rest of the financial plan.
Yeah, just being an order taker in my business as well as your business can be very dangerous, because we're not probing and trying to find out what the real need and the real desire of the client is, right? So if somebody says, "Hey, I want this," my natural conversation would be, "Well, why? How does that serve your purpose?" Right? So I think what I hear you saying is like you like to know what's all going on with that client in the financial picture, because it's going to be important because they're going to be after revealing that on the documentation, but also serving the client's ultimate needs and wants, right?
Yeah. I mean, and that's what we always get. Every year I go to the Circle of Wealth and all these conferences and speak at some of them and train. And sometimes, and a lot of times, I'm just kind of there to learn. When you bump into new people and you say, "Oh, I'm actually in the mortgage industry," they kind of give you like a weird look, like, "What? Did you stumble into the wrong meeting? Like, what are you doing here, buddy?" And for us, it's a passion that we've had for all these years. My dad started that. If I'm gonna say I'm gonna partner with Wade, I gotta at least know something about Wade other than his beard. You know
Yeah.
what I mean? I got to know what kind of business he runs, what kind of client he's looking for, what kind of service he's providing. And then, like I said, being Switzerland, we're just the mortgage arm of that. Whether you are, you know, your philosophy is pay the house off as quick as possible. Your philosophy is what I describe to more is like using the house as leverage for cash flow to put money in other vehicles and not paying your house off so quickly. We don't really share our opinions. What we want to do is we want to understand our partners' opinions and then be able to reciprocate to their clients so that the financial plan stays intact. So, it's really just really important for us to know what and who we're dealing with, not just borrowers, but the advisor. And so many people in my industry don't do that. And I'm not here to hate on them. I love everybody in the mortgage industry. I'm not a bad talker. But a lot of times what I would say is their ignorance is their death. They don't know enough. They know how to do the mortgage, but they don't know that maybe there's a better plan or there's a more aligned program because, Wade doesn't know anything about mortgages. That's where my expertise comes back to Wade and says, "Hey, there's another opportunity here for your client. And before I talk to your client about it, I want to lay it out for you. Does this fit what you're doing?" All that's very important. The average mortgage company, they're ignorant of what's on the other side of the table there. And that's really where our greatest value is. I don't have a Matt Shanlian mortgage that everybody gets and it's lower rate than everybody. It's really about how we can tie into the financial plan.
Yeah, I mean, Don says it all the time: is there's more money to be lost by stopping the leaks in your system versus making more money. And same goes for you. Is like if there's a reason why somebody has to pay a little bit higher rate, or maybe they want to structure a little bit differently, or whatever it's going to suit them. As long as we know what it is going in, then we can find value, because it's not always about price, not always about interest rate. It's about value. What value does that extra $20 a month, or an extra $6 a month actually get you for doing these things? So what I like about what you're saying, and just is that alignment is that I'm not going to be here forever. You're not going to be here forever, but our clients that we're trying to serve is we need to empower them so they understand why they're making the decisions they're making. Because then, well, if we're not here, they already know, or at least have an idea of, okay, this is why I made this choice, or Matt or Wade helped me understand why we're headed down this direction, versus us being the ones that think that we're the gatekeepers. Because that's always been my approach. Is I never want to be the gatekeeper. I want to empower you, to be the director in your own film. Let me just kind of step back and allow you to do that. So,
Yeah. I look at it and say, what can, my industry, and I think Wade and sometimes your industry too gets painted with a bad brush because it is commission based sometimes, and
yeah.
depending on the products you choose. And so then what's that advice? If, are you compromised because your advice has a dollar amount attached to it? And so, and I will tell you, I have said no more in the last 18 months as rates have risen to our financial advisors and their clients and ideas they had. Maybe, should I do this? Should I take out a line of credit? And, we look at all the options, and maybe it's a better option to actually just rebudget what they're doing, spend a little bit less and attack their debt that way. That's a more efficient time where rates are. And so it's a really big passion for us, especially for our loan officers that work in my group that work in this arena, to give sound advice, and meaning our no means no. And because a lot of people can make, as we know, decisions or want to make decisions emotionally, want to make a decision just to make a decision because they're bored. We get a lot of those people like
Yeah.
that just kind of want to refinance because why not? And when you lay it out there, go, geez, the closing cost of this, you're not really making a big move. And so it's very important for us to say no and make our no's, because that allows our yeses to be even more strong when it's a true yes. Like, this is a great idea. This is the right time. Let's pull the trigger. Remember 6 months ago we said wait, or you weren't in the right position, or let's work on your credit for the next 2 or 3 months to get your score up so your rate can go down. Not just say, well, I can get you this. That's good enough right now. Like, really working, because we're talking 30-year mortgages. We're talking permanent insurance. We're not talking, kind of churn by churn products. So when we actually pull the trigger on those transactions, we want to make sure we're making lifelong or long lasting, at the very least, decisions that make sense, not just something that comes in. And we're all both great salesmen. My staff, great salesmen. We can get the phone to ring and call somebody and find a net tangible benefit and hit our calculator long enough to find a savings. But we want to stay away from that, because a lot of times in our industry, people do that, and that's not good for people's financial future, to be honest with you.
Yeah. Well, to your point, you said you've been doing this for 20 years. I've been in the insurance industry for 35 years. I figure I'm halfway through my career. So I have, my vision is very much a long-term vision. I think long-term, I want long-term relationships. Quite frankly, I want the right long-term relationships. And I think that's what I hear you saying as well, is like, if people don't buy into what my values are and what I believe in, um, which again, if their beliefs are, what they want to believe in and what their values are, we just want to make sure it's a good fit. So because again, I don't want, and nor would anybody want to work with me that we don't have a good fit. So that's why I think I hear you saying, and that's why I appreciate this conversation with you, because it is truly a value-based conversation. It's not a rate, or it's not a dollar-based conversation. We have this conversation all the time about life insurance, and life insurance is really the greatest love language I think that's out there, right? You have to have somebody to love in order to take life insurance out. But we also have all these living benefits that are also very valuable. And part of those goes back kind of what you were saying earlier, is like, who controls the dollars? What we talk about with infinite banking, this idea that you should have your, all your, free cash flow sitting in a policy, is because it's got tremendous value. And those values are the guaranteed growth. It's going to go up every month, guaranteed, period. End of story. That's a huge value. It gives you guaranteed access to credit. Now, we were having a conversation with a banker a while back, and he came into the office, and he made the comment. He says, so we're telling about how we have unstructured loans and we have a guaranteed line of credit. And then we were talking about some of the other benefits and how we work with our clients. And he said, wait a second, I want you to go back on that. So we had to explain to him what we meant by an unstructured loan and a guaranteed line of credit against our policy. And he was blown away. So the question came, what would you charge for that? What would you, he says, well, if I could, he said, quite frankly, I can't offer those type of terms, but it would be, 20 or 30%, because we just have no way to figure out what the risk is. So the point being, I guess I'm saying that to just kind of come back to the conversation with you, is like, when you're having a conversation with one of my clients or somebody that has alignment of my values, you probably already know that, 15-year mortgage probably isn't, what they're, what they're into, although they might be, but you want to lay out here's what that means and here's what that means. But I know what you guys talk about with the infinite banking concepts, you might want to have control of your money versus having you be in control of that money. So maybe you want to speak to that a little bit.
Yeah. I mean, it may sound, like the antithesis of what I should say, being working from this side of the aisle, the numbers are not always the numbers, meaning, when you say, 15-year rate, well, look how low the interest rate is and look how much interest you save over that period of time compared to a 30-year mortgage. And we can talk about that from forever. One of the things I always harken back to is when I was in college, I had an economics professor, and he made us write on the top of every page and every paper, everything we turned in. I love leverage, and you have very little to no leverage with a mortgage company or a bank. You just don't. I have all leverage. Just being honest with you. Meaning, the other thing I like to say a lot, we laughed earlier when I was talking about it, was, a mortgage is generally basically a qualified account. Not literally, but in theory, because every time that you want to pull your equity out of that house, you got to qualify for it. And you got to qualify for it not on the terms you want, on the terms that I want, the market that's happening at this stage. So would I love to be giving every one of my clients 3% mortgages right now? Yeah, but that's not the rate. Right now it's in the sixes and sevens. And so when you are in that realm and you need that equity back out of your house, whether it's because of a home improvement or you want to start a business, or worst case, you've maybe lost a job or suffered a loss in household income. If you don't qualify for those funds with your debt ratio, I can't give you the money. I don't care how much equity you've built. And so it's very different than a life insurance policy because, you can correct me if I'm wrong, Wade. If I have a life insurance policy and you're my life insurance or you're my financial advisor and I have a cash value of $100,000 in there and I say, hey, I need 25,000. Do you ask me what I'm using it for? Do you ask me how my job's going? Do you ask me any of those questions?
Well, so I would ask those questions, but at the end of the day, only question that's really important that has to be answered: how do you want it delivered? By check, or should we EFT it?
Exactly. And so it's your money. And so when we think about it as home equity as this pile of money that is growing in certain areas. You're going to have natural home equity growth. Right now, we're seeing home values. I mean, over the last 5 years, we've seen home values in many parts of the country raise up to 50%, sometimes even double in value. So that's natural. That has nothing to do with you. That's just you waking up in the morning and the market around you being positive. The other equity that you grow is when you make payments on your mortgage. Well, we believe that we should try to have the smallest mortgage payment possible so that the maximum amount of monthly cash flow can go towards that type of permanent insurance policy or financial plan, because those are the places that you can actually pull those funds out of. And there's not a qualification if you have the money in there. The other thing that we talk about, and I don't want to be the life insurance person here, but I'll tell you, right now the average interest rate's like 6.5%, 30-year fixed. Yep. That is a daily interest. So that means your interest grows every day. There is an interest calculation every day for 30 days, every month, that your mortgage balance grows every day. And then you make a payment, and then you beat down that interest, and you pay down some principal, and then it grows up every day. And every mortgage note that I have has an end date. We have to have a 10-year, a 20-year, a 30-year term, a 15-year term. Wade, you can speak to what a life insurance policy, when you say on $30,000 of life insurance policy, what's the term to pay back?
Yeah, so somewhere around 5%, and they say, here's what the interest cost is, and we'll just apply it to the lien that we have against your cash value of your policy. Because that's the beauty, is that your money stays inside your policy. It doesn't have to come out to be used. It doesn't have to be consumed. Going back to what your economics professor said, it's being leveraged because you're borrowing the insurance company's money. Think about how, everybody says use OPM. Well, when you do, which is other people's money, right? When you're using a policy loan, your money stays in your policy and you're using the insurance company's money to go do whatever you're going to do. Now, one of the things, to your point, I think you understand this, and I really appreciate the fact that you get this part of it. If people go, hey, I could do a 30-year, I could do a 15-year, I get a slightly better interest rate maybe on a 15-year, but again, that's because it benefits the bank, it benefits you to have somebody's money back quicker, right? Mm-hmm. But also think about it from the standpoint of, hey, the money is, if we can take whatever that same difference is and put it into our cash value immediately, the difference between a 15 and a 30-year, now you have 15 years of reserves that you can build up where you have control, not the bank having control.
Yeah. And, we all assume life is going to be, all rainbows and unicorns, and I'm never going to lose my job. I'm never going to, maybe something unforeseen happens to a spouse and that changes your financial picture. And so That's why we like the 30-year. And my joke always is, you can pay a 30 like a 15. You can't pay a 15 like a 30.
Yeah.
If you pay a 15 like a 30, that's called foreclosure. We take your house. You can have a 30-year note and pay it off in any time period you want, other than the first 6 months. We have a prepayment penalty for the first, 180 days. I always joke with people, if you hit the lottery, go on vacation for 6 months and then pay your mortgage off, or you'll get a penalty. But we look at the 30 years, the most amount of flexibility, because if we're diverting that cash into our financial plan that's liquid, that's accessible, that has terms that are better. If I have a cash value of $500,000 in a infinite banking in my policy, and I have $500,000 mortgage note, and I could write a loan anytime and change my 6.5% rate to 5% simple, and I wanted that was the financial leverage play that made the most sense for me. You absolutely can do that. You can pay it off. But why would you want to then lock up all that equity? If you wanted to get it back, you got to ask me for it. The Grim Reaper shows up and says, "Hey, I'll give it to you, but 30-year fixed, or here's the rate and here's the pay." So we would. That's why we love the fact of like that flexibility and growing that access to your positioning your equity, into another vehicle that's a lot better, easier to attain, a lot better terms, and letting your mortgage, as long as the financial plan, your cash flow fits, letting your mortgage stay a mortgage as long as possible. Yeah. Because outside of the day you move, that's the only time you can get your equity out for, quote, free, after you pay a real estate agent some percentages and after you pay maybe some gains if they live there long enough. So this equity game, it may sound weird that the mortgage guy is like, I always joke, like I should open a website that said, don't give me the money.com. I think all the money should be going elsewhere. You should be making the small minimum payment, always the minimum payment on a 30-year fixed, and diverting as much cash flow away from us, because you're just not in control of the terms when you need to pull it out from me.
Yeah, and the other side of that is of that equation is, once you have your money in your policy, is, hey, it's a great place to save it. I'll say that right up front. Life insurance policy, my whole life policies, what we teach people is that it is not an investment; it's a savings. It's a place for you to store your cash, store your wealth, and to leverage and use it when you find the right opportunity. And now you've been in since the early 2000s. So you remember 2008 probably really well. Mm-hmm. But think about all the people that had all the people that had free cash flow, free access to dollars. What kind of killing did they make in 2008 and 2009 and 2010 versus those that were like, making the max payment and made advance payments, and all their free cash flow was going to pay off their house that was now worth 30 to 70% less than it was 6 months prior.
Yeah, and we've had stories through the years, and there's some, we won't name them, some radio hosts that have a pretty specific theory on mortgage lending that seems to now be changing because somebody has given him some mortgage money and now he has a sponsor. But our radio guy that loves to tell everybody to eat beans and rice and sell your car and sell your organs and to get debt free. We've had many times actually somebody that came to our office. He's a dear friend, and nobody would know him, but goes to church with us, and he was a big radio host fan, and basically he was living that life, and he was, they were not going on vacation, they were not doing anything, they were putting everything on their mortgage, they were in the 15-year mortgage and making double payments, and he was, I want to say, about 20 payments away from paying his mortgage off, and he came in and said, "Hey, so my wife just got diagnosed with Parkinson's, early onset Parkinson's. I want to not mess up the diagnosis, but she was a nurse. So she's got to not be able to, she can't work full time anymore." And he said, "And I just got noticed that I'm getting laid off my job," which I had a very good job as an executive in some tech industry locally here. "And I'm getting laid off at the end of the month. And, I just wanted to come in because it's going to take me some time to find another job, because I'm not going to go get a Joe job. I've some expertise. My wife is not going to be able to work as much. And, my house is worth $400,000. I owe like $27,000 on it. Can I get just like a line of credit to see me through?" And, we couldn't help him because his wife was making $18,000 a year all of a sudden, and he wasn't making any money. And, and we said, you look at all you've been doing, and the finish line is right there. You have been starving yourself to get to this goal, and putting all your eggs in this basket, and but now life happened, and it's sad, it's terrible, health happens, but now we can't pull this money out of your house. And
Yeah.
he kind of looked at me shocked, like, what do you mean? This wasn't part of my radio host plan. Like, he said that everything would work, and then I'd be cash free, and then I'd be a millionaire, and all of these things. And I followed the playbook, Matt. What happened? And like I said, we're not here to rag on anybody else's philosophy in financial services, but if you don't understand that the equity you build up, you have to always qualify to get out unless you sell your house. So we had the conversation, and basically what he ended up doing was taking a 401k loan. That was his only option, because of course he was dumping all of his money in his 401k. So he had to take a 401k loan and take a beating on the taxes on that, and all those things that happened to see himself through. Meanwhile, he was sitting on $350,000 of home equity.
Yeah.
Now let's reverse that and say he did an infinite banking, or he worked with Wade, and instead of having $350,000 in home equity, he had $300,000 in cash value in his policy. That isn't a stressful scenario at all. Oh, I got laid off. Okay, well, Wade, hey, I had some bad news. Wade goes, well, great. Look at all these options we have. We can do it this way. We can give you a little bit now. We can do it month, whatever you want to do. And the stress is not even apparent. But for him, it looked like, I destroyed his financial philosophy, because he had no idea that if something bad happened before he made it to the finish line, he's pretty stuck if he's just putting all of his eggs in the home equity basket without anything else. Home equity and qualified account retirement. And that's what he had. So we use that example a lot. It's sad. He's still a buddy of ours. But when you're not leveraged, the word we used earlier, when you don't have proper leverage in your financial plan, when bad things happen, you're stuck.
Yeah, boy, there's such good lessons there. I mean, I think about that. The first thing came to my mind when you were sharing that story was, if he was a client of mine and he got laid off, and I said, and he had $300,000 in cash value or whatever the number would be, my first thought would be, hey, what is it you really want to do in life? Right? Do you want to take this as an opportunity, not a bad opportunity, but maybe this is an opportunity where you can develop some sort of home-based business, or whatever, find a passion of his and say, no, let's take advantage of that opportunity, versus being this scarcity mindset of like, I don't even have, $20 to pay the electric bill because I took all my money, dumped it in my house and my retirement plan, which probably at the time, because this always happens, is that when you need money out of your 401k is probably the worst time to try and get it out, because you're having to sell out of those positions. Not always, but a lot of times you're having to sell all those positions when the market is down. It's taking a beating. Now you're taking an even bigger beating because you're actually having to sell out of those positions. So I just look at it as, how do we take an abundance mindset? Some of the things like the gentleman on the radio talks about, I'm all for. I mean, that's the beauty. When people bring his name up, I'm like, yeah, man, I agree with about 80%, 90% of what he says. Get out of debt. Be in control of your debt is the word he should use, not get out of debt. Just be in control of your debt. Because there's people that have, it's not a savings problem, it's a spending problem. Yeah. And people bring, I'm sure they bring financials to you all the time. They go, hey, can we get a mortgage? And I'm like, no, absolutely not, because you can't afford to pay your bills, let alone that $2,500 mortgage that you need to extend out on. So, he's got it partially right.
Yeah, you would be surprised how many times, and this is, this actually breaks my heart to share stuff like this, but like, you would be surprised how many times we will do a consultation with a financial advisor and their client. And I'm not talking about a client that is struggling from income standpoint. Household income of, $250,000, $300,000, $350,000. You go, man, these guys are all right. They're bringing home, $30,000 before taxes. This is going to be fine. And, then we pull their credit and we look in and we find $75,000, $80,000, $100,000 in credit card debt, and 3 cars and a timeshare account, which I've not ever seen anybody ever be happy with one of those after you buy them. If that's the first financial advice I can give you, is always walk away from the table. But we see people, like you said, a spending problem, great income. And then we see part of what we have to do. I was, we financial, like blood work basically in a loan. I look at your bank statements, and we see at the end of the month, there's $19,000 of deposits, and at the end of the month you have $1,100, and you're still waiting to go. Okay, well I can go to the grocery store Saturday because Dad gets paid Friday. We'll be good. And these people make a ton of money. And it's because there's a lack of plan. And so, like our radio buddy that we're not going to hate on, it does great for people like that to give them a reality check. But when we're under leveraged, when we don't have any holdings of our own to be able to wade through these bad times or different opportunities, because everything is in home equity or in a qualified plan, and we're not. And maybe they do teach the emergency fund and everything. And our friend had an emergency fund, but he's like, hey, I got 90, 120 days maybe saved in cash, but not a lot.
Right.
You look at that and go, that's not really leveraged well. And so that's what we want to try to teach in all of these things is like when we're looking at helping people buy a home. They go, what? I want to buy a $400,000 house. Why? Well, because my friends bought one, and that sounds like I deserve that size house. Well, we don't look at the purchase price. We look at the payment. What payment can you hold? $2,000 payment. What's your down payment? We back our way into the purchase price. But the first thing we need to establish is what payment fits your budget,
Right.
not what purchase price can you qualify for. You're answering the last question first when you do that. You don't want to backdoor into the right financial decision there. And so that's a lot of education we try to give people is because they just don't know. And then they talk to a mortgage person or a realtor. Realtor's making money the bigger the loan. Mortgage person's making more money the bigger the loan. So we're going to say, hey, and you want the dream home, and you want that school district, and you want this new neighborhood, and you want this. And then you get in the house and go, gosh, this is fun, but we can't go on vacation anymore because this is what our vacation is, these four walls. And, they just don't think of the life around the house that they buy and slowing people down and making sure that they answer those questions and then leave themselves some leverage for rainy days. It gets me excited that we get to do that.
Yeah. Yeah. And I think, because there's an old adage. I work with a lot of real estate investors and real estate people that are buying real estate. And the common phrase I hear and put a lot of different ways is that you can't eat equity. You can only eat cash flow.
Mm-hmm.
You have to have cash flow. Equity is just in all reality, it's a fictitious number until somebody's willing to give it to you.
Exactly.
And so, we talk obviously a lot about cash flow. And one of the things like we talked about is if you redirect that payment that would have been to pay it off in 15 years, how about the possibility of saying, let me find one or two maybe rental properties that can make my mortgage payment? Mm-hmm. Then you working with a guy like you say, hey, this is what our plan is, because it's all about having a plan. What's your long-term plan? Say, hey, we have our house. We want to finance it or refinance it, whatever it might be. We're going to take that difference. We're going to build up our savings or reserve fund. And then we want to buy these two other rental properties, or maybe you got some cash set aside. Also, now we're buying the second, third, fourth rental property. So the net cash flow maybe can make our mortgage payment for us. I mean, wouldn't that be a better position to be in? Because that in essence is now, I don't want to say you're debt free because you still have debt. Things still have to work out. But now you have those, having basically three other people make those mortgage payments plus the one of the house that you're living in.
Yeah, and this might be part two, Wade, because I got so much information on investment purchases and how to even utilize your infinite banking policy as almost like a setup to your financial plan or your real estate investment business, and using the policy as the funding source. We have specific loans just for investors that allows you to close your loan in an LLC, allows you to not bring in your personal income. All of these things where we can use, we can start a policy with cash and then use that as down payment money, and then use the cash flow of the investment property to refunnel back and pay the policy back. And now you're funneling or enough cash flow to buy another policy to grow. There's all these things that you can utilize and do with real estate and permanent insurance that are very complementary of each other. Now, there's a deep dive there, but we do solutions like that all the time. Not always is it debt consolidation to free up cash flow so somebody can buy a policy. Sometimes we're using like a single premium policy to the advisor. I'm not using it. is using like we're getting equity to put in a single premium policy, and that's what the funding vehicle for the investment purchase is. Again, we can show how that works, where you can loan against and then repay, and loan against and repay, instead of having a home equity line of credit on your house, where you got to ask them every time, and then every once in a while they say, "Hey, well, your line's frozen," or you can't use this any longer because now you have to repay it. Instead of having a line of credit on your house, have almost like a line of credit for your policy, and using that as a funding source back and forth, and you can scale up with property. So, like I said, probably a part two if we ever do one. But it's just there's so much that the housing market and permanent insurance are complementary of each other, and I'm a mercenary to try to connect both sides because we see the value and we have for many years.
Man, isn't that this is so much fun being able to work, in collaboration instead of in, conflict with each other. I mean, this conversation we just had, the last half hour has been super exciting to me because there's so many areas that we haven't touched on. So I'm like, oh, you're right. We have to do a part two, but there's other areas that I guess my biggest takeaway I'd like the listeners to come away with would be this, find an expert like Matthew, find somebody that can speak to exactly what your desires are and kind of what your strategies are, and not, don't see it as threatening. Say, hey, if that's what you want to do, great. Somebody that's looking out for your best interest. Now, Matt, if they want to find you, if the listeners want to find you, how do they find you? What's the website? What's the email? Man. What's the Facebook? You tell me how you want people to find you.
The easiest thing is my email. It's on my hip all the time. So we have, like I said, we're licensed in all 50 states. I have a team of loan officers. I'm kind of the communication tip of the spear, especially if they're an advisor or just a client of an advisor. Like I like to be the welcome call there or welcome contact. So Matthew dot and then my last name Shanlian at ccm.com. ccm as in Mary.com. My phone number direct is 330-414-8856. 330-414-8856. Either one of those is easy. If you literally, like my website is crosscountrymortgage.com/Matt Shanlian. If you want to go that route and find out that I'm a real person and I have a face and all that fun stuff. But yeah, reach out to me anytime. I mean, even if it's a scenario, we do a lot of work, especially if you're somebody that's just kicking the tires, you're thinking about, I want to get in the investment thing, or I want to make a decision. Maybe my kids are gone. What do I do with this big old house? Yeah. That's a great conversation to have with your advisor too, because a lot of people, they go on vacation to Florida, Arizona when they live up north like us, and they go, I don't want to go back. This stinks up there. And then they go buy a condo, and you go, what just happened? And I'll live on less because the sun's out. And you want to make sure that like those kind of purchases are run through that same filter that we've made every other financial decision moving forward with our infinite banking concepts and with our private reserve concepts and all that stuff. And so we want to make sure that happens. I'm not going to get pumped that you're buying a place near a golf course in Tampa. We're going to make sure that Wade is going to say, maybe not on the golf course, maybe across the street from the golf course. That fits your budget, and we don't make a bad decision. So all that stuff is important because it's the household. It's where we make our memories. It's where we live. But it should not be over thought in as far as like an emotional standpoint. It's still a financial vehicle. It's still something that we can utilize for good. A lot of times housing is utilized for bad because it's utilized poorly.
Yeah. Or it puts us in a bad position, right? Yeah. It just can beat us up. And, they say that your house is one of your largest financial investments you can have. And I would say it's never going to be the first. The first is going to be your investment in you, right? You should be spending the type of money to understand these type of concepts because, hey, Matt, as great as you are, you can't read people's brains, neither can I. So the whole idea is that we want people to invest themselves. Call you up. I'm sure you got a ton of resources to help educate people, just like we have a ton of resources. If people want to learn and understand infinite banking, I mean, we do deep dives, we have education videos. We have a ton of stuff where we can bring people up to speed. So they're not dependent on me being the gatekeeper, as it were. So
we're not the gurus, but we've learned from the gurus, and we continue to learn from the gurus of the industry. And,
right.
To me, that's you're not you haven't met my father, and I do hope someday that we all get to. He's still a special guy, but he's grown our company as just a humble place and a servant to the financial services industry and the people that really understand permanent insurance and fixed life insurance. And so we have just serviced this community for so many years, and we enjoy people who talk. The funnest thing is when I call somebody that's from this world, and they just brag about their 7 policies. Well, I got this policy, and I got this policy, and I got this policy, and this is for my kids, and that's awesome. And the last thing I always tell people too is, in my office we have 37 employees between all my branches, and we are not just people that work in this industry. One of the things you do when you become a permanent employee of ours, we have a 401k that our company has. But my dad still holds his licenses, and we still believe in permanent insurance. And as of today, we have $17.5 million in death benefit
Nice.
inside of our walls. And I don't know the cash value. I can't be that personal. But I ask everybody what their death benefits are. And we calculate every year because it can't be an asset to a community that you're not also involved in. And so we believe in it. We use it as a funding source. We use it in our financial plans. And we love supporting the community.
Yeah. Well, I appreciate that. I'm going to ask you one. I think you kind of gave me this answer, but I'm going to just be real clear about the question. If there's one bit of advice you could give to just the general public about, taking a mortgage, buying a house, whatever it might be, what would that one piece of advice be? And I know I'm putting you on the spot. So as you think about it, I'm just going to do real quick housekeeping here. Remember to subscribe to our podcast. Remember to like and share this conversation, especially if you got people out there that are they're talking about, wanting to get a mortgage or refinancing their house or buying a different house. Hooking up with a guy with Matt, in his organization, Cross Country Mortgages, is huge. This is the financial awareness we talk about. This is the financial IQ we want you to raise in yourself, because here's a guy that just doesn't think about, hey, I need to sell your house because I need this commission, and I'm on to the next thing. He's a long-term relationship person. So again, Cross Country Mortgage is his name of his company. It'll be in the show notes. But again, subscribe and like our podcast, share it with other people. Go to Sagewell Strategy if you want to see other podcasts and other strategies as we talk about this. So again, I would encourage everybody to check that out and check Matt's website out and send him an email if you got questions, just to get educated. So try to give you a little bit of time to think of the
long enough.
So what you got?
I mean, the main advice that I try to give everybody first is it's about the payment. It is about the payment. It's about, if we're looking to buy a home specifically, it's about the payment. And in the point B to that is cash flow is king. Yeah. Cash flow and control is always your best friend. So when we're looking to buy homes, obviously we get on our Zillows and our Redfins and all those websites, and you talk to a realtor, and you get, we're starting to see some inventory actually return to our communities, which is good. But we look at purchase price, and we look at bedroom, bathroom counts and everything. It's like you're starting with the end. What we need to start in the beginning is, what's the payment? What do we feel good about? Then we go to, what's the down payment? What can we use? Now we know the loan amount. We can add a down payment on top of that. So if you can pay $2,500, and that's a $300,000 loan amount, and you have a $100,000 down payment, guess what we just found out? Your budget's $400,000. But you may start looking at $530,000 houses, and then your spouse walks through that kitchen of her dreams, and now what are we doing? We're bargaining our future because we want to make somebody smile. And so do the financial work ahead. Find the payment, find your down payment that'll get you to your purchase price, and then stick to your guns there. And you will not be house poor, and you will still be able to have that cash flow and that control of your future. And that's the best advice I can give anybody, is have control of your own future. Don't let me control it. I am your friend, but I have rules that I can't change, that if I have to control it, you're going to abide by it, and so will I.
Yeah. That's a great point. Be the one that's control your future. So again, Matt, I appreciate it. All the information will be in the show notes along with this. But just encourage you to reach out to Matt. Any state that you live in, he can help you. So thanks again for your time. And we're definitely going to make a part 2 about investment real estate and financing. Great. Matt. Thank you, Matt.
Thanks, guys.
Okay, well, hold on.